Crude is down 2% for 2024, and our next guest says that's because oil has lost its mojo as a speculative bet or investment play. Joining us now is Tom Kloza. He's OPIS Global Head of Energy Analysis. Tom, good to talk to you today. Let's start right there. That's what kind of stood out to me on your note, talking about how some of that lack of mojo within oil is capping some of the gains that we may have seen in the past. Walk me through your thinking there.
Sure. I think this is hiding in plain sight. If you look at oil and you look at the fascination people had with oil as an investment or a speculative vehicle, back during the ages of the Arab Spring, it was a great place to park money. It was a place that you would see a lot of speculative money go. But it really has lost its mojo. I mean, now that money, that hot money, that fast money, that huge money goes into crypto and it goes into big tech. And there are a lot of people, including many, many well thought about analysts, who are predicting that we're going to go back to the days where there's 10 buyers for every sellers on the speculative side. But I would submit that we may never go back to that. I mean, oil is something that is capped certainly 15 or 20 years from now in terms of demand. And it just doesn't have that same lure to the investing public as it had before.
So, Tom, I'm curious, bottom line, if Brent here is at 73 and change, what do you see over the next 12 months?
The three words to keep in mind are front-end loaded. The first 100 days of 2025 should be front-end loaded. There's enough uncertainty with Trump 2.0 and with possible tariffs and with increased pressure on Iran and Venezuela, probably send oil prices up a bit. But ultimately, OPEC, would like to put out a little bit more oil in April. We think they may actually keep the production cuts through the end of 2025. The world doesn't need the oil. And they have about 5.5 million barrels a day of spare capacity. So they've got a real problem. I mean, after we adjust to some of the uncertainty related to the Trump presidency, I think prices may come down, and there's a much larger risk next year of a big price drop, to $50 or $60 than there is to something in the 80 plus range. It would take something on the order of the Russian invasion of Ukraine or a wider Mideastern war to really send oil prices back up to those 22 and 23 highs.
So you're looking at $50 to $60 a barrel. I mean, is that based off of just demand that's out there, or the lack of demand ultimately that's going to bring some of those prices down?
I think demand's decent. I think demand will be up 5, 6, 7, 800,000 barrels a day. But we're coming out of a couple of years where it was up 1.2 and 1.3. And the other side is that, there's consideration perhaps that China has hit its peak gasoline demand. I saw some stories this morning that said that EV sales in China are going to surpass ICE vehicles very shortly. And it's pretty easy to implement EVs in China when you have an autocracy there. So, we're going to get some additional demand from India. The United States gets more drivers, but the vehicles are getting much more efficient. I do think we'll see a slowdown in EV adoption in the United States, but we used to use 9.3 million barrels a day of gasoline from 2016 to 19. Now we use about 8.8. And, kids don't get excited about getting that first car and driving all over the place and taking road trips like they used to. They like the teeny weeny world of different gadgets and stuff.
Tom, with Trump coming back in the office, we'll see how different policies shake out. But on the demand side, tariffs. On the supply side, Tom, it's perfectly possible Trump comes back in and really does slap new, tough sanctions on Iran. If that were to happen, Tom, what could that mean for the oil market?
Well, not too much, because Iran's principal customer for exports is China, and they're only exporting about 1.5 million barrels a day. I think the market is anticipating that there will be additional restraints on Iran and probably Venezuela. Venezuela has the greatest proved reserves in the world. But as long as they have the Maduro administration down there, they're not going to be able to tap that reserve. So I think those things are factored in. But we've got new oil from Guyana. We've got plenty of oil coming up in the Gulf of Mexico. You don't hear much about it. You hear about the Permian Basin, but there's probably 500,000 barrels a day of deep water or shallow water Gulf of Mexico oil that's coming on stream in the middle of this decade.
Yeah, Tom, can you speak on that a bit more? I mean, Guyana is a place we hear often from these oil companies. They see a huge reserve, there's a huge opportunity. As we sort of see not necessarily retreat, but as you said, more sanctions on Iran, on Venezuela. How are we seeing the landscape shifting, particularly in this sector?
Well, we may see it shift. I mean, we'll still probably see discipline in the Permian Basin where, I talk about the 7 and 7s, where it takes maybe 7 months to employ a rig and find some oil in shale, where it's maybe 7 years if you do it in the Gulf of Mexico or deepwater Africa. So, you're not going to roll back those big projects. You're going to see oil come on from there. And in some cases, they have $20 or $40 break-even numbers. So that oil is coming on stream. It won't be killed by prices briefly below $60 a barrel. It's actually a pretty optimistic viewpoint going forward. I think oil is going to be profitable enough for smart companies and companies who monitor costs carefully to do well. But I don't think it's going to be the kind of thing that really adds to inflation like we saw in 2022 or 23.
Tom, always good to see you and have you on the show. Thanks for joining us.
Thanks, guys. Have a great new year.
You too.